Hello and welcome to the first lecture of BUS 550 Global Finance. This week we're talking about free cash flow. To begin the lesson, we're first going to talk about the different parts of the class that we will be going through, and then we will get into the lesson. So there are two parts to the class. The first part is the way to measure a firm's value. And we talk about the manager's goal or objective, which is to maximize the value of the firm. And that could be fundamental or intrinsic firm value. And then the other way to measure value is maximizing shareholder wealth based on the market price of stock. So that would be the first half of class. And the second half of the course is we'll talk about ways to increase value. And within that, the manager has 3 decisions to make, and those are operation decisions, investment decisions, and finance decisions. And that's going to be the last half of the course. So you remember taking accounting, and the accounting approach was a little bit different. In this class, we use the finance approach. And the finance approach has us focusing on cash rather than accounting profit and loss. So for this class, we will be focusing on cash rather than accounting profit and loss. So we'll still do a little bit with the financial statements, but then after this lesson we get more on money and cash and capital and costs of other areas of the firm. So one of the ways to measure firm value is based on free cash flow and the weighted average cost of capital. What this equation represents is the present value of the firm's free cash flow discounted at the weighted average cost of capital. And we'll learn more about weighted cost of capital later on, but this right here is the present value of the firm's free cash flow or FCF, and it is discounted at the weighted average cost of capital. Or WACC. So here, the firm's value, we have the free cash flow, and then down here is our weighted average cost of capital. And this part we will get to later on in the term. Today's lesson, we're going to focus on calculating free cash flow. So what does free cash flow include? It includes cash from operations, cash after tax, as well as non-cash flows, so depreciation and amortization. So for this, we will be using 2 of the bank statements, or the financial statements of the firm, the balance statement and the income statement. And here we go. So to calculate the free cash flow, we need some line items from the income statement and some line items from the balance sheet. Okay, so we're going to go through what is part of the free cash flow and where on these financial statements to find that information. And hopefully these are some financial statements that you remember from taking accounting. So to calculate free cash flow, we right here, free cash flow, it's equal to NOPAT, which we will get to, and then we subtract net investment in operating capital. So what does NOPAT stand for? That is net operating profit after tax. Okay, so calculating NOPAT is EBIT times 1 minus the tax rate. Okay, this right here, the NOPAT information, will come from the income statement. And it's considered operating income. Okay, and then we have this here, EBIT. This stands for earnings before interest and taxes. Okay, so what is that actually? That is considered revenue of the firm minus expenses, excluding tax and interest. Okay, so we take this revenue and then multiply it by 1 minus the tax rate. And that's how we get our net operating profit after tax, which is the first part of our calculation. The next part is the net investment in operating capital, okay, which is equal to a change in TOC. Okay, TOC stands for total operating capital. And to find that, the change in TOC is going to be the TOC from the most recent year minus the TOC from the previous year. Okay, so how do we calculate a change in total operating capital? Well, we have all of these acronyms here that we're going to discuss. So, for this right here, total operating capital, we need to find the NOWC, which is net operating working capital, and add NFA. NFA is the net investment in fixed assets. Okay, so this would be for the most current year that we're calculating. And then we do the same thing for the previous year. Okay, because again, we are comparing, or we're calculating the change, right? It's a change in TOC from one year to the next. Now, how do we calculate net operating working capital? We need to find our operating cash assets minus operating capital liabilities. Okay, and we do the same thing. We calculate it for the previous year, and then we calculate it for the current year. And we're going to do an example of all this. Okay. So there's a lot of calculation that goes into this, but it's set up so that it makes it a little bit easier to understand, and we're going to get there. So this is the list of the key equations that I just discussed, but they're written out for you. So again, we have the net operating profit after tax, which is equal to EBIT times 1 minus the tax rate. Okay, and to get our net investment in operating capital, we need to find our total operating capital, our net operating working capital, and our net investment in fixed assets. So when we come down here, our first step is to calculate the change in total operating capital, and that is going to be the net investment in total operating capital, which is the TOC from our current year minus TOC from the previous year. How do we calculate TOC? We take our net operating working capital plus net investment in fixed assets. What is our net operating working capital? We take our operating current assets and we subtract from that our operating current liabilities. And again, we do this for the previous year and the most recent year, right? Because we are calculating the change from one year to the next. So what exactly do firms use for their, or how do they use their free cash flow? They can use it for multiple things. So they use it to pay off after-tax interest. They can use it to reduce debt. They can use it to pay out dividends. They can use it to repurchase or issue stock. They can purchase short-term investments. Okay, just a reminder, free cash flow is equal to our assets, which is equal to our cash flow of debt plus cash flow of equity. Okay, so again, this is all based on cash flows. So here is a balance sheet and an income statement from a company that we're calling Remy Road. For 2 years, we have 2014 and 2015. I'm just going to open up. Here we go. So, to the left is our balance sheet and our income statement. And then on the right side of the screen is the sheet that we're going to fill out to calculate our free cash flow. So we can see the first step here is to calculate our net operating working capital. Our net operating working capital is calculated by finding our operating current assets and our operating current liabilities. So the first one we're going to do is for 2015 because we're going to find free cash flow for the year 2015, which means we need information from 2015 and then 2014, the year before. So net operating or the operating current assets are going to be the current operating assets, not including short-term investments, okay? Not including short-term investments. So what is this equal to? We're going to go to our balance sheet, okay? So our operating current assets are going to be our total current assets right here. Now, if we had short-term investments, we would deduct it from this amount, but we do not have any if we look, right? These are our assets. These all are included in our total current assets. So we have $15,572. So I'm going to come over here. Normally you would do this in a spreadsheet, but I'm going to put 15,500, 300 $1,072. Okay. Then we're going to find our operating current liabilities. In our operating current liabilities, we want to be sure that we do not include notes payable. Okay, we do not want to include notes payable. So where do we find our operating current liabilities? Again, we're going to go back to the balance sheet and look at the heading for liabilities and come down to where it says total current liabilities. Okay, we want to make sure that we are not counting notes payable. And we do not have notes payable here. So we're going to take this amount here, and this is going to be our operating current liabilities. Now you would take these values, the 15,372, the 11,462, and subtract it to get the net operating working capital for 2015. When we do that subtraction, we're going to get 3,910. Okay. Then we would do the same exact thing for 2014. So again, operating current assets for 2014, we're going to go ahead and look back to our balance sheet, and this time we're going to look at 2014. And our total current assets, 14,520. And operating current liabilities, 93,76. Again, we don't have any notes payable in our current liabilities, and we do not have any short-term investments in our assets, so we don't need to worry about subtracting those values. So now when we do the calculation here, we're taking the 14,520, subtracting the 93,76, and we're going to get 51,44. So now we have our net operating working capital for both 2015 and 2014. So now we're going to take that information and use it to help us find total net operating capital. Okay? Because for our TOC, we need our net operating working capital. So for 2015, our net operating working capital is 3910. And then for our 2014 net operating working capital, we have 5144. Okay. Also part of our total net operating capital is our net fixed assets. Okay, so we need that information for 2014 and 2015. So if we go back to our balance sheet, we're going to find our net fixed assets, and that is actually our plant, property, and equipment. So if we go to our balance sheet and we look, plant, property, and equipment right here. So we're going to take this value for 2015, which is 24,069, and put it here. And we'll do the same thing for 2014, 24,448. Okay, and then when we add those values up, we will get the official TOC for each year. So for 2015, we're going to have 27,979. And for 2014, we're going to have 29,592. So now we have our TOCs for 2015 and for 2014. So what we're going to do next is calculate the investment in total net operating capital. So we subtract 1 year from the other. So we're going to take 2015's, this is the current year, minus the previous year. Okay, so the current year is 2015, so we have 27,979, and then 2014 is 29,592. So our 2015 investment, total investment in operating capital is a negative 1613. Okay, so that is our second part of our equation for calculating free cash flow. We have our investment in TOC, which is a negative 1613. Now we're going to calculate our NOPAT, or our net operating profit after taxes. So we take our EBIT from 2015. To do that, we're going to look at our income statement. Okay, so our income statement gives us information that we'll need to calculate the NOPAT. So for this example, our EBIT, we're going to come to our operating income. So this is our EBIT. This is the earnings before interest and taxes. So for 2015, which is the only one we need, is 7766. Okay, and then we're going to multiply that by 1 minus our tax rate. And our tax rate is on our income statement, and it is 0.37, or 37%. So if we take 1 minus 37%, or 0.37, we end up with 0.63. So we take that value, the 7766, multiply it by the 0.63, and we get 4893. So this is our NOPAT for 2015. So now we have all of the information we need, the two values we need to calculate our free cash flow, because we needed our NOPAT, which we have right here, and we needed our net investment in operating capital, which again is up here. So we're going to take the 4893 and subtract the negative 1613. Okay, so when we do 4893 minus a negative 1613, we're going to get 6506. So our free cash flow is 6,506. Okay, the next step is to figure out what the firm did with their free cash flow. How did they use their free cash flow? So we're going to come up to this part of our spreadsheet and figure out the uses of the free cash flow. So the first thing we do is, this actually should be after-tax interest times 1 minus the tax rate. So the after-tax interest, we're going to find on our income statement for 2015, and it is our interest expense. So how much was the interest? So that is going to be $632. And we're going to multiply that by 1 minus the tax rate, which we already figured out from the previous calculation is 0.63. Because the tax rate is 37%, we turn that into a decimal, which is 0.37. 1 minus 0.37 is 0.63. So we're going to come back up here, and we're going to multiply that by 0.63. And we're going to get $398. We do get decimals here, or cents, but we just round to the nearest whole dollar. So the interest is $398. How did they use, what was their change in long-term debt and notes payable? So we're going to go to the balance sheet and calculate the change in long-term debt and notes payable. So did they take out more debt, or did they pay down their debt? So that's what we're trying to figure out. So to do this, we're going to take their long-term debt and notes payable from the previous year, so 2014, and then take the value from 2015 to see if they took out more debt or if they paid off their debt. So in 2014, we can look on the balance sheet, and we have long-term debt. So our long-term debt is right here, and we're going to find it from 2014. We don't have any notes payable. We only have this long-term debt. So that's what we're going to write in, the 10,758. And we're going to subtract the value from the 9475. So in 2014, they had long-term debt in the amount of 10,758. In 2015, they have 9475. So that means they paid off some of their long-term debt. And when we calculate that, we get 1,283. So they used some of their free cash flow, it looks like, to pay off some of their debt. The next category here is the payment of dividends. So how much did they pay out in dividends, or did they pay out anything in dividends? So what we would look at is somewhere. Please hold. I will be back. Dividends paid. right here. We have 2841. So 2841, 2841. Okay. Then we're going to calculate changes in common stock. So again, we do the difference between 2014 and 2015. So this includes multiple categories. So we're going to go back and look at our balance sheet under our stockholders' equity. So this is going to include common stock. It's going to include additional paid-in capital. It includes treasury stock. Okay, so we're going to add common stock, additional paid-in capital, and treasury stock. Okay, so for 2014, we have 87, 6966, and a negative 6694. And when we add that up, we're going to get 359. And then we will do the same thing for 2015. 88 plus 7948 minus 10694. And when we do that, we get negative 2658. And that is equal to 3017. And the next one is change in short-term investments. This company had no short-term investments, so we are not calculating anything there. And then we would add up our total use. So our total use is going to be the 398, 1283, 2841, 3017. But how we calculate this is going to be different depending on how our calculations. So we know that they paid off this amount, the 1283. They also paid out the 2841. And then there's this 3017, as well as the 398. So we know that they paid off and paid out these two values right here, right? Because we know that they had, so this value right here, the 1283, they paid off some of their debt, right? So they took their cash and they sent it to whoever they owed. So that is part of the payout. They paid that out. This 2841 dividends is also money that they paid out. Okay, so we're going to add these two values together first. And when we do that, we get 4124. Okay, and remember, our total free cash flow that we calculated is 6506. Now, our total use may not equal that exactly, but we should come close. So right now we have 41.24. Next we have change in common stock. Okay, so they paid out some common stock of 3,017. So we're going to add that to the 41.24 that they paid out. So when we add that, we're going to add the 3017. When we do that, we get 7,141. Okay. Then what we have left is this after-tax interest. Just 398. So we're actually going to subtract that because that is what they brought in. That's the cash that they brought in. So when we subtract the 398, we're going to get 6,742.84, which is close to 6506, but again, not exact. So I'm going to put this here for total use. 6,742, and I'm just going to round that, actually. 6,743. Okay, so that is how they used their free cash flow. Now we're going to calculate our MVA, okay, which is the market value added. So did they add value to their firm, or did they destroy value, right? That's what we're going to calculate here. So to find this, the first thing is that you will be given the price of their stock. Okay, so the price for these, we need to calculate 2015 and 2014. So the price in 2015 was $124 per share, and the price in 2014 was $115 per share. Now, how many shares did they sell? We can find that by looking on the income statement. So if we look down here, we have our basic. Okay, these are our basic shares. So in 2015, it was 1,499 shares. In 2014, it was 1,562. To find our market, we're going to take our price, multiply it by the number of shares. We'll get our market capital. So for 2015, when we do that calculation, we get 185,876. For 2014, we get 179,630. And then what we do is we find our book values. So the book value, again, we're actually going to come over to the balance sheet and take on the total stockholders' equity. Okay, so first we calculated the market value, now we're calculating the book value. So our book value in 2015 is $17,777. Which one is first? 2015. So 17777, and 2014 was 17,898. Then we calculate the difference between the market value and the book value for each year. So we're going to take the 185,876, subtract the 17,777, and the difference is 168.99. For 2014, we do the same thing. We subtract the 179 and the 17,898, and we get 161,732. So the difference in 2015 was $168,099. 2014 was 161,732. So it looks like we went up in value. So what we do is we take these two values and we subtract them. And when we do that, we get 6,367. And that's a positive value. So if we see a positive value, that means that they added value to the firm. Okay, they added value. It is worth more now than it was the previous year. If it was lower now, so if we got a negative value, so for a positive, that means they added value. If we get a negative value, that means they destroyed value. Okay, so they reduced the value of the firm. In this example here, they added value because we have a positive. Okay, so this is the example. You are welcome to go in and do it on your own. I will post another example for you if you would like to practice. And we will do examples in class when we meet on Tuesday. If you have any questions, please don't hesitate to contact me. My email address is in the syllabus and in Canvas. Otherwise, have a great rest of your week, and I will see you in class on Tuesday.